All right, thanks for that. I haven't done anything yet, so I don't know exactly why you're clapping. But I'm going to try and make this very interactive, okay? So ask questions whenever you want, raise your hand, or just ask questions. I'm going to be focusing on due diligence, but I'm going to take a very broad approach to the whole concept of due diligence. So this is not going to be an accounting class, because I would fail miserably in that. But really take a broad approach to due diligence and try and explain to you guys how we look at companies and how we go through the whole due diligence process in evaluating what is a good investment and what is not. I'm going to be doing that on the basis of an investment that we made in a retail business. Before I do that, let me give you a bit of my background in addition to what the professor just mentioned. I kind of came into this business in a fairly unorthodox way. I spent many years working for the Benetton family, and then later also for a gentleman by the name of Les Wexner, who is the founder and majority shareholder of the Limited Brands that owns all of these apparel and consumer good companies. And I was exposed to kind of the whole M&A sector by doing transactions in a corporate setting. So we did a whole slew of transactions when we were in the Benetton group, where the Benettons decided in the early 90s to start diversifying, and we bought all sorts of businesses, including infrastructure deals. We bought the Northern Italian road networks, which still is in the hands of the Benetton family today. We made investments in telecom, we made investments in consumer good companies, and then similarly at the Limited Brands was involved in a similar capacity in a number of fairly large transactions. And I got a lot of exposure to buying these companies that were typically kind of middle market companies, so anywhere between, let's say, $100 to $1 billion in revenues, and the complexities and issues that we dealt with in incorporating these businesses into the larger corporate setting. So then later, I went into private equity after I went back to business school, and to this day, I continue to be in this business, and I have to say that I actually love what I do. It's a tremendously fun and interesting business and multifaceted business. I just have to figure out how this thing works. Here we go. All right, so I told you a little bit how what we're going to be doing today. I'm going to talk a little bit about the private equity core competencies and then really go into due diligence. I'm going to try and stay away from kind of the technical stuff with respect to the technical accounting stuff, but really conceptually try and explain what we do on a day-to-day basis when it comes to due diligence on the basis of a transaction that we did. Now, this transaction that I'm talking about is a small transaction. It doesn't matter, however, because it had all sorts of interesting aspects to it that, regardless of the size, you'll deal with in a private equity context. Before I start, who has any experience in private equity or has worked in a private equity firm? Okay, quite a lot of you guys. And in just Fran, what kind of context were you working in private equity?
So I was working in a private equity firm in Spain, my home country. It's a mid-market company.
Okay.
We're doing deals from 200 million to 800 million.
Okay, and what were you doing there?
So I was an associate. So basically, I was in charge of operating models and LBO models, negotiating debts with banks, and helping the principal in directing the consultants in the market and staying.
Okay, good. Well, let's start then with, and we'll go through this very quickly. What is it that we do on a day-to-day basis? I mean, so we're private equity men and women. We have a lot of capital that we're backed with. And what is it that we do on a day-to-day basis in our offices? I mean, so we all talk about doing deals, but it's not as easy as that, right? So Daniel, what is it that we do on a day-to-day basis? Where does the whole process start?
Identifying potential targets to acquire and add value if possible.
Okay, so identifying potential targets to acquire, okay? So how do we do that?
Well, we usually contact some investment banks or firms that have been approached by by firms that want to sell the company.
Yeah.
Or do an IPO and
Okay, so investment banks, right? So we depend on what else? What else do we rely upon from finding interesting investment opportunities?
Networking.
What networking?
Your colleagues, your friends, your family, you try to reach as many people, potential investors and business owners as possible, and this is how you ensure a certain deal flow, potential deal flow.
Okay, so go ahead.
Consulting reports, just where they look at the company business and where they see if the company has a strong cash flow and like it's well positioned in the industry.
Okay.
So we can support the
Right, so we source deals. Uttam, what else?
You can hire a buy-side broker if you want to target a particular segment of the industry. You can hire a buy-side broker and go to trade shows and have them put deals together.
One of the hardest things that we do, and particularly in this day and age, where the markets have become incredibly efficient, meaning there are buy-side brokers, there are investment banks, there are people that have networks and friends and family. It is incredibly hard to find proprietary deals. So what's the issue of finding non-proprietary? If you get approached by an investment bank, what's the issue with being approached by an investment bank?
There will be other private equity shops bidding
Right.
for the same deal. Probably the price will get higher.
Exactly. So an investment bank, these guys, are probably better in networking than we are, and they have a whole slew of companies that they've developed years of relationships with, and the company is eventually up for sale, privately held company, let's say, just for the example, and they show it to a whole slew of private equity firms. They run an auction process, and you end up paying a very hefty price to be able to close that transaction. So sourcing deals, and don't forget this, is incredibly hard. And it's becoming increasingly hard because the markets have become incredibly efficient. The private equity business has become an industry, and there are hundreds and thousands of investment banks in Europe and the United States, and increasingly so in Latin America, and increasingly so in Asia, that are all running after these investment opportunities, and it's very hard to find interesting opportunities that are proprietary. Okay, so what else do we do? So we spend a lot of time trying to find interesting investment opportunities. What else? Is that all we do?
I mean, in terms of sourcing that, or the things that
No, forget sourcing. Let's move on to the next.
Reporting and fundraising did a lot.
Okay, fundraising. I'll get back to that. So, but that's a very important point. I'll come back to that in a minute. What else do we do?
Follow your investments.
Follow investments, okay. So how do we do that?
You're usually in contact with management of the firms, and you prepare reports or data for the boards.
Okay.
And you assess them also in strategic issues and financial issues, and dealing with the banks and all that stuff.
So when we do an investment, we typically take a board seat in the investment. So several members of our firm will take a board seat, and we oversee the investment and the execution of the investment, and we oversee essentially management reports then to the board, and we oversee so that takes a lot of time, and it's a difficult process. Okay, what else? We talk about sourcing, we talk about fundraising. I'll get back to that in a minute.
Maintain relationship with lenders so you're able to borrow to finance
All right.
it.
So we've got fundraising and debt financing. Okay, we're in the business of doing leverage buyouts, right? And to finance these transactions, we need to have debt. The whole process of raising equity and debt financing for any transaction is a very, very difficult and very complex process. Raising $1 billion fund, it just doesn't happen from one day to the next. It's a very difficult and arduous process. It's very, very competitive. There are a lot of people trying to do what you do. The LPs and the LP community, whether it's pension banks, whether it's family offices or endowments, these people know what they're doing, and they're very good at picking good managers who have a good organization, who have a good setup. So the whole process of fundraising is a tremendously arduous process. It takes a tremendous amount of time. It costs a lot of money as well. And you can end up empty-handed too. So the whole process of fundraising and also raising debt financing for transactions, particularly in these markets, and I'll get back to that at the end of this lecture, is a difficult process. Okay, what else do we do? So that's it. So we raise funds, we source deals, what else?
You execute on the deals you source.
Okay, so we execute on the deals that we source, right? Which is what?
Due diligence, negotiations.
Okay, due diligence and negotiations. Do you have any experience in negotiating private equity transactions?
Yes.
Okay, so tell me a little bit. Is that an easy process? Is it a hard process?
It's very challenging because oftentimes you need to reconcile between the expectations of the management or the owners or whoever is selling the business and as a fund, the return requirement, the risk profile, and so on and so forth.
Right. So negotiating transactions is another, it's a pretty complex type of business. You have to have it a little bit in your fingers. The sellers have to like you. You have to come up with a good bid. It's not only about price. I've actually won auction processes, not by paying the highest price, but having the best structured deal, having the best relationship with the management team, developing the best relationship with the sellers, and coming up with a transaction that is really doing right by the business and doing right by the company, and really ensured that the sellers felt happy to whom they were selling the business to. Now, private equity business, and particularly in Europe, by the way, we do transactions in Europe as well, has developed a very bad name. The whole concept during the last 5 or 6 years, the whole concept of doing these leverage buyouts where you would buy a business at a high purchase price multiple and kind of justified that high purchase price multiple by using tremendous amount of leverage, and 2 years into the whole investment, you're breaking through your covenants and in the worst case going bankrupt. So these types of structures and transactions, people are becoming much more savvy about that, and negotiating and structuring transactions in a way that, in an effective way that you can actually make the acquisition of the business is becoming increasingly more difficult and competitive. All right, so I'll just quickly go through that. So we talked about sourcing. We'll get back to about due diligence. Due diligence is incredibly important. Due diligence is not only financial due diligence, it's much more broader than, and we'll get to that in a minute, but we spend a lot of time on due diligence. Now, just a minute about valuation. How do you know what you pay for a business? Sylvia? What should you pay for if a company walks, or an investment banker walks through the door, gives you all sorts of information about the business, so how do you determine what the valuation should be for the business?
So you will do some market-based valuations, you may do some comps, you want to see what other companies paid for the business, you will run your LBO model, seeing what your return is, because you know what your return requirement for your fund is, so you have the maximum level how much you can pay.
Right.
You look at that number compared to what other transactions in the market went for to get some kind of estimation of the market value.
Okay. And so how do you determine that ultimately what price you should be paying for the business? I mean, you can do all that work, but so what? So you have all this information. What are you going to pay for in the end for the business? What really truly determines what you end up paying for the business?
It depends on the competition. If there's other bidders in the process, it will bring the price up. If there's no competition there, you will try to go as slow as you possibly can get.
Yeah.
And go to get your return up. There's competition there. It will determine how many rounds there are. They will tell you need to bid a little bit more to get to the next round. You will do it.
Okay.
So you finally at the end, and then you will get some guidance from the banks where you stand within the bidding, and then based on that you will decide if it's worth for you to spend more time to find synergies, to find other ways to pay more for the business and still generate your return.
Okay, Diego, you wanted to make a comment?
It was the same thing. I mean, that's your walkway value. You should try to increase your return by providing other sources, as you said, by having a relationship with the management and bringing ways that you can add value to the business to pay as lowest as you can.
Okay. The whole concept of valuation has gone completely haywire and certainly during the last 4 or 5 years. The people have been overpaying for these assets for years and somehow justifying the price by using a lot of leverage. That whole game has changed now. The debt financing that these companies used to be able to get for justifying these types of deals are no longer available. So it's becoming increasingly more difficult to justify a high valuation, a high purchase price for a particular business. Financial modeling. So just very quickly. So who's run leverage buyout models here in the past in the private equity context? So you guys here, Uttam, to tell me a little bit about, okay, what's really the concept of a leverage buyout model?
The key concept is basically forecast free cash flow.
Yeah.
And figure out how much of the debt can you pay down and what would be the what kind of EBITDA would you have when you're trying to exit the company, and what would be the final return to the equity holders?
Right.
That is the basic construct of
Okay, so it's a very simple concept, right? You basically look at the cash flows of the business. You kind of try and identify how much debt and what kind of capital structure this business can sustain over the years, and it spits out. What does it spit out at the end?
The return to the equity holders, the cash on cash and the IRR.
Right. So the cash on cash return and the IRR and the IRR. So a lot of people will understand how to do this and develop leverage buyout models. Well, what's really the important part of that?
To figure out what are the key growth drivers, what are the key drivers of the business activity.
Okay.
And model the business. If there's seasonality, then you figure out what is the right time period. If there are other structural drivers, then you identify what those are and what are the drivers behind them.
Right. Okay. So the whole concept of leverage buyouts is not so difficult to understand, and actually running leverage buyout models is not that difficult. The whole point is what you're really putting into that. And if you really understand the underlying asset, the underlying business, how the financial operation of the business, and what the future cash flows of the business are going to be. And if you get that wrong, you can very, very quickly, the whole investment can go south, and before you know it, you can go bankrupt. We talked about debt and equity financing. We talked about negotiation and deal structure. A little bit about exit planning. I have come across many, many investment opportunities where we were kind of talking about an investment opportunity, said, well, should we do this, yes or no? And we were very much on the fence about this particular investment. When you make an investment, have a very, very clear idea of actually what the exit is going to be. Because if you're on the fence of it, about this particular investment opportunity in good times, and you want to sell it in 5 years from now, and the business is done so-so, you're going to have a hard time selling the business down the line. So don't buy businesses that are unsellable just because you are desperate to get a particular transaction done, or don't underestimate the difficulties that you might run into of investing in certain companies and certain businesses where it's very difficult to exit out of the transaction because the business is virtually unsellable. And there are certain companies that are very, very difficult to sell. Go ahead.
So in your opinion, because if we're talking also about the largest or the largest number of competitors that you have in an auction,
yeah,
then your price is going to be higher. Right?
Yeah.
So it means that if you have a business that is difficult to sell and you have the opportunity of analyzing that business, maybe you're going to get a better price, but you're going to have some more problems in the exit planning.
Yeah.
So my question is, how you can make a business that is not very sellable into a, convert it into a sellable business in a time period of 4 or 5
Well, that's
years.
exactly where your due diligence comes into, is evaluating this business and thinking, and being creative in your thinking and thinking, okay, what is the likelihood of taking this business and setting it up for a much more interesting business, a much more interesting operating model, healthier cash flows, a better management team, and what is the likelihood of succeeding in, let's say, a matter of 4 or 5 years, and to whom might we be able to sell that business? And you'd be surprised how many businesses are bought with people not thinking about how they're going to exit. And I have come across hundreds of companies that are owned by private equity firms that they've had for 10 years. And these companies come up every 2 or 3 years, and they hire another investment bank, and they try and sell the business again, and nobody wants to touch it. Don't underestimate it. You could be stuck with a business that's doing $500 million in revenues, and it's just a business that an investment in an industry, take an industry, I mean, we were talking about it earlier, about the printing industry. Printing industry is going through a tremendous demise. There are hundreds of private equity firms that made big investments in the printing sector because they had the wrong strategic approach. Now these companies are owned by these private equity firms. Nobody will touch them. And so they're continuing to hold them. They still cash flow, they've paid down the debt, but they can't sell them. Go ahead.
Is it more industry and sector driven, or there are also certain aspects or characteristics of a business that when you see you should run away?
It can be a structural. I'll give you an example. We're actually looking at a business right now in the aerospace and defense sector. It's a business that, and these businesses can be actually very, very good, and we've got some very, very good advisors in this sector. But they're in the business of buying and selling parts to airplanes, okay? Not commercial airplanes, but actually military planes. And this company has bought this huge inventory of parts of military aircraft from a wide variety of European and US manufacturers. The problem is that there are two problems with this business. The ownership structure make it very, very complicated. There are a number of investors and a family office that's involved in this company, and the family is running the business. And secondly, the inventory hasn't been properly cataloged. So they really don't know what they have. It's actually a fairly big business. It's a big business that has a huge amount of inventory that is actually cash flowing quite nicely, but they haven't cataloged their inventory. And we're talking about millions and millions and millions of parts. And so they're trying to find somebody who has the guts, basically, to step into this business, to make a valuation of the business, to spend a huge amount of money in inventorizing all of these spare parts of these planes and making a bid for the company. It's not so easy. You have to have somebody who's willing to do that. Anyway, there are many examples like that of these quirky companies that can actually be large, but they're very difficult to sell or to buy. Okay. Okay, so we talked about what we do on a daily basis from a private equity perspective, and actually all of these facets of any type of deal making make this business tremendously fun and interesting. This guy called me and he said, "Look, I have this idea. There are all these luxury optical retailing stores here in the United States, and they're incredibly profitable. It's a very fragmented market." And I know all the owners of these stores because I've sold stuff to them over the years. And I think that you guys should take a look at this with me and back me about and potentially making an acquisition of a number of these companies in the luxury optical retailing business. So, and he's told us a little bit about the sector and about the business, and it sounded like a pretty interesting idea. We were stores all across the United States, potentially even in Europe. They had pretty high margins. It was a fairly fragmented market. So we said, okay, let's take a look at it. So where does this process really start? So what do we do next? So we have this idea. We have this guy who walks through the door with this idea. And he says, well, I have relationships with a number of these owners of these types of companies, and you guys should back me in doing this. So what would you do next, Gus? Were you in my shoes?
Well, I have to ask for a business plan. What is he doing? With the, I don't know, he wants money, or he spends for the money.
Right.
And so you can really assess if these plans are worth your time and your money and your efforts or not.
Okay, so it starts with doing a little bit of due diligence on this industry, right? So what this guy said, there were all these stores all across the United States. In this little group that he was talking to was like 25 stores. So it starts with kind of a due diligence process. So what is it, what we're trying to do with due diligence? What does it really mean? Aaron?
You're trying to verify, I mean, for this specific case, you'd probably be trying to verify the economics of the store and, you know, what he thinks is achievable, whether that can actually be achieved.
Okay, but it's think of due diligence in kind of like a more broader concept. I mean, what is it that we're really trying to do through due diligence? Go ahead. I mean, it comes to that, by the way. I mean, obviously we have to do kind of the financial analysis of, and the understand, let's say, the economics of these stores, but what else?
In a broad view, I think you're just trying to confirm your investment thesis and,
exactly.
and what you're evaluating it.
Right, so due diligence is really kind of trying to understand the benefits and the liabilities of proposed investment and trying to understand kind of the past, the current situation of the business and where it's going to go in the future, right? And in addition to that, you're basically trying to understand, really get a very, very thorough understanding of this business, how it operates in its environment, and use that information to come to an accurate valuation of the business and develop predictable financial models. So, and this is really one of the hardest things that we do in the private equity business. There are so many businesses that we see on a daily basis. Now, we must have looked at probably about 500 transactions in 2009. Okay, so we looked at 500 transactions, and so we're constantly seeing these opportunities across a very wide range of different industries and sectors in the consumer, in the industrials, and manufacturing, aerospace, and defense sectors. And there's certain similarities between companies in each of these different industries. However, every single company is different. And it's very difficult to develop a nose for what is a good company and what is a bad company. What is a sound financial operating model and what's a bad one. It's not that easy. And you can't look at financial statements of a company and just say, well, okay, this looks pretty good, you know, pretty good EBITDA margins, pretty good cash flows. You know, it's much more complex than that, and it requires also a certain intuition with respect to the business, but also being able to put together all of these different due diligence aspects that you're looking at, not by yourself, but with a wide team of people, and boiling it down to your understanding of the business and evaluation. Okay? So what it really involves is from top to bottom, looking first at the macroeconomic environment. So we've got this optical retailing business, and it really starts with doing a macroeconomic analysis and how these businesses and industries kind of develop in fluctuating macroeconomic environments. Okay, so from the macroeconomic environment, what's the next step? Where do we then go into? Carlos.
In terms of the industry?
What?
In terms of next.
What other due diligence elements are there apart from kind of macroeconomic environment, seeing how the industry performs in a particular macroeconomic environment?
Sure. So once you've assessed the industry, you probably want to dig into the specific aspects of the firm, both the firm's operating performance and then the management team. Okay.
All right. So we look at the financial operating model, the operating model of the business. We look at comparable and precedent transactions, and then we obviously do financial due diligence, right? In addition, you look at management. It's very, very hard to do a proper evaluation of management. I've made so many mistakes with that, where you can have great management teams that are great PR people, but it really comes down to really running the business. They may not be as good as they claim to be. So it's very hard to do a proper determination of how good the management team is of a particular company. Go ahead.
Yeah, I have one question. So in the situation described, it seems like it was a case different from, you know what the company you're going to acquire and you jump on it and you do whatever you need to do. Now it seems like there is a theme that your friend thinks it's interesting and you're going to explore. So how do you go about this particular phase of establishing a strategy, how to go about a certain interesting theme rather than looking at a specific company and try to dig deeper on it?
Well, I mean, what we did, this guy walked into, and it often happens like this, this guy, but even if an investment banker comes to you with a CIM that thick, you still have to take a step back and you have to say, okay, how does this business that we're looking at, how does it perform in a particular industry, right? So where's the company positioned according to its competitors, and how does it perform, how does this industry in general perform in the US market or in the US, European, and Latin American market, okay? So you always have to kind of take a step back and look at the industry, and is this a viable industry that you want to invest in, and what is the competitive set in this particular industry? It's pretty, you guys have done this 100 times before, but people sometimes forget to do that. So they become myopically focused on the financials of the business without kind of taking a step back and say, well, should we really even be looking at this industry in the first place? So with this optical situation, we kind of looked at the industry. We looked at and I'll come to some of the work that we did in a minute. And we decided, actually, well, this could be a really interesting situation. Okay. So financial due diligence, you look at management, legal. Big mistakes are made in private equity type of investments without doing proper legal due diligence. So I don't do that. We get a whole slew of lawyers. Our lawyers are at Kirkland & Ellis, and they evaluate the transaction structure, but they also evaluate the assets that we're buying, and you can make some big mistakes with respect to buying these type of assets where you find out that they're huge liabilities. I'll give you an example. Recent example that we dealt with is we looked at doing consolidation play in kind of gas station type of businesses. So these are gas stations across the United States. They have 200, 300 gas stations, 3 or 4 different companies with maybe a total of about 1,000 gas stations. Notoriously difficult business when it comes to liabilities and environmental liabilities, because these gas stations, turns out, are leaking gas into the ground, right? So these gas stations have been around for 25 years or so. They have these kind of tanks. They leak gas into the ground, and before you know it, you've bought 1,000 of these things, and you're dealing with huge, huge legal and environmental liabilities that you didn't foresee. This is a more kind of obvious example, but they're less obvious examples that if you haven't done your legal due diligence and your environmental type of due diligence properly, literally you can get notice from one day to the next and your investment is virtually gone because you didn't foresee something properly. So spending the money on due diligence, but also managing the due diligence process effectively is incredibly important. And what we do is we already manage this process. I mean, we're not doing the legal due diligence ourselves. We hire people to do that. We have a whole team of 30, 40 people working for us in a particular transaction that do all of these different aspects. We have KPMG working on the financial due diligence or certain aspects of financial due diligence, the management assessments there. And here again, this makes private equity investing in the United States a little bit easier. There's a whole industry in people who do management evaluations. You know what? It's always been worth spending the money on these types of situations. And in a minute, I'll give you an example how we made mistakes. Sure, go ahead.
In your view, when's the right time to hire outside firm for a due diligence or legal and financial due diligence? After you sign a MOU or any agreement for you to be the only bidder, when do you bring them on board?
Well, actually, this is a very good question, because one of the things, what keeps us alive and what keeps our business alive is the management fees that we get from our LLPs, right? And hiring Kirkland & Ellis and the accounting firms is an expensive proposition. And when you do a $100 million transaction, before you know it, you're spending $10 million in due diligence fees. So you have to be careful as to when to decide that you pull the trigger on hiring all of these people on a retainer basis on a particular transaction. That said, you can't wait too long because you have to show the sellers that you're also committed enough to actually spending the money. So, and this goes back to kind of the negotiation process. In some cases, we've actually hired our due diligence team earlier on in the process because we were very eager for the particular investment to show the sellers and the investment bankers and the lending institutions that we were very committed to this particular transaction. So if you further along than your competitors and the other people that are bidding for the transaction, that can actually help you getting the deal done earlier and sooner ahead of the time that some of your competitors are. So timing is a critical issue in this game because particularly the investment bankers, but in many cases also the sellers want to get the deal done as soon as possible. So one of the things that you see, for example, is, I don't know if how familiar you are with the process of doing private equity transactions, but it typically starts with signing an NDA, then you get a investment memorandum from the investment bank, then you submit an indication of interest, which is basically an indication of kind of the valuation range that you guys are, that you're interested in bidding for the company, and then you're selected with a smaller group of people. You're left on the basis of the valuation that you put forth in your indication of interest. You're left with a smaller group of bidders, and then you have to make your final bid in the form of a letter of intent. Now, the difference between a letter of intent and an indication of interest, does anybody know what that is? What's the core difference between a letter of intent and an indication of interest?
A portion of letter of intent is binding once the LOI is executed.
Wait, just to make sure that I got that right. What?
LOI has two sections, like
right.
at least the ones that we drafted. The one section is a binding.
Okay, you said a portion of the LOI.
A portion of the LOI is a legally
Correct.
binding contract.
Right. An indication of interest is say, okay, we'll probably, we'll pay you this for the business, more or less. A letter of intent is actually a contractual agreement. So there's a portion of it that is indeed binding, and the other important aspect of a letter of intent typically is that you have exclusivity, meaning that nobody, once both parties have signed it, nobody else, you basically are protected to spend all your money on due diligence to be able to work towards a closing without being outbid in the process. Okay, is that clear? Go ahead.
So more and more they're, like the Bain and McKinsey's of the world, they sell like, business due diligences to PE funds. Do you use that a lot, or do you do it internally?
Absolutely. And I mean, these businesses are around not because, some publicly listed corporation needs help to, to figure out what their strategy is going forward. Not only that, but all of these consulting firms have huge private equity operations where they help people like us do due diligence work. And in fact, what they do, Bain does growth and strategic analysis type of opportunity. You say, okay, we have this company. It's grown 10%, the 10% CAGR over the last 5 years. Okay, pretty good growth numbers. It's a $500 million in business. How can we take this business from $500 million in revenues to $1 billion in revenues over a period of 5 years? Okay, and what are the problems? So we hire Bain to do a whole analysis and figure out and do a very, very precise and careful analysis on what the likelihood is and to mitigate some of the risks there and to ensure that we have a good plan in place. Go ahead.
Back to the growth. I don't know if this is within growth and strategic analysis, but consolidation is a common type of thesis you'll have in private equity. When doing a consolidation play such as this that depends on multiple acquisitions, how do you go about understanding if it's actually feasible, if those owners will sell, if you actually have a chance to get
It's a really good question. And consolidation plays is there's a lot of jargon in this business and a lot of kind of, oh yeah, consolidate. We're going to do a consolidation play in this industry. Consolidation plays are incredibly, incredibly difficult to do, and a lot of them fail. And I'll get to that in a minute. Okay. Right.
There's so many things that you can diligence on. I mean, a lot of your consultants work by the hour. How do you think about whether that marginal dollar or marginal hour of time should be spent, or is this enough and we need to make a decision?
Well, that's the art of what we do. And no, it really is, and it's a very good question. I mean, why should we be spending, $500,000 on Bain to put, a thick report together of something that we could probably do ourselves? Well, we definitely couldn't do it as good as Bain does it. What I've found out is typically, if you're managing a process like this, where there's so many moving elements and there's so much to think about, it is typically better to have more due diligence information than less. And because what you're getting is really you're getting on one particular aspect of the transaction an outside opinion. And you can disagree with them. And by the way, we often disagree with our consultants in these deals. We often disagree with with KPMG on a report that they put together. We disagree with Bain. We disagree with our consultants, our operating advisors on these particular transactions. But it does, in the end, mitigate some of the risk, and it doesn't leave it. What's very important is that it leaves you with a situation that you're not caught by surprise, and things will never work out in the way that you actually expect them to. There's always something in a particular transaction after you've done the transaction that it didn't work out in the way that you expected it to, or you some sort of surprise happens in the transaction that you didn't expect. By doing the due diligence and covering all of these aspects and working with people who already know what they're talking about and working with people who are very thorough and give you an outside opinion, you mitigate some of the risks and you eliminate some of the surprises. Go ahead.
Quick question. Part of the diligence is also done to get the lending community over sort of the hump.
Yeah.
Around to understand some of the risks. Can you comment on how that's changed from their perspective post the crisis? So are they looking more for deeper business reports or deeper analysis?
Yeah, it's a very good question, and it has changed actually. I would be amazed sometimes in kind of 2006, 2005, how easy the banks were. And just as a little sideline, the use of leverage in these types of transactions is a dangerous game, right? You're playing with fire, because the more leverage you use, the thinner the margins are between being able to service the debt and your cash flows. And if you get it wrong, and if you're caught, and if you haven't done your due diligence properly, you'll find yourself in a situation that you don't have sufficient cash flows. It's as simple as that. You don't have sufficient cash flows to service the debt, right? And you blow through your covenants, and it all gets very, very ugly very, very quickly, right? Because the banks will have you by the nuts. And it's really an unpleasant experience. I mean, I've been through it, and it becomes a very, very nasty game because the banks are basically, I mean, you have good banks and you have bad banks, but typically if you've really over-levered the transaction, you really get into serious problems. In kind of 2005 and 2006, I was amazed sometimes how easy the banks were and how laconic they were with respect to financing transactions. It was amazing. I mean, they were throwing money at you. And I actually, and believe it or not, we did a number of transactions whereby we went back to the banks and said, well, thanks for your offer in leveraging this at a 4 times leverage multiple, but we'll only take 3. And they couldn't believe it. They said, well, you should take 4. We're offering you 4. Why wouldn't you take it? And by the way, 95% of the private equity firms would take 4. so the banks were laconic with respect to, and bad in their due diligence process. They basically kind of followed the lead of the private equity firms and kind of towed to the line of what the private equity firms were telling them. That has changed now. And the banks are becoming smarter about who they lend to, who they work with from a private equity perspective, and how thorough their due diligence is. And the banks, what happens is the banks work with a combination of the work that you provide them. So it's sometimes good. I mean, if you want to get a bank on your side, it's good to have a thorough Bain report and a thorough KPMG report and a thorough management report done by a human resources firm and a thorough environmental report, because it gets the banks over the hump to lend you a large amount of capital for the transaction. So it has changed, and the more thorough that your due diligence work is, the easier the process is. Okay? Go ahead.
With regards to the banks, is it still the banks are still relying on your fruits of your due diligence, or are they trying to get themselves into the data room to engage their consultants?
Well, I mean, the banks have three sources of information, right? They have the information that they get from the investment banks, which is usually worthless. I hate to say it. I don't know. Who's an investment banker here? There you are. So we're typically Erica, but we take the CIM and we love kind of like getting on the phone with the investment bankers and kind of saying, well, that doesn't make sense, or I'm really kind of grilling the investment bankers.
But if we didn't start there, where would we end up?
Of course. So, and by the way, there are definitely, I'm making a gross generalization, but there are definitely investment banks that do really, really great jobs. And it's not actually the big investment banks necessarily that do great jobs in putting CIMs together. There are some smaller investment banks, like middle market investment banks, that are incredibly thorough, incredibly reliable in the information that they give us. So the banks work with three sources of information. They work with materials from the investment bank and the due diligence material that the investment bank puts together for the debt providers as well as the private equity, as well as the buyers. And they work with materials from the private equity firms. And in some cases, if the bank is thorough, they do their own due diligence work. But it's very limited. And it doesn't cease to amaze me how limited the work typically is from the bank. They get on the phone, they take all the material in, they do their own analysis, but they don't spend money themselves on doing their own due diligence work. Typically, they don't. Go ahead.
I mean, each fund has its own way of doing business, and is there any item in your checklist that's like black or white? Just it's a no-go. Like for instance, if you don't like management, you can go like, oh, change management or somewhere else. Is there an item that's very sensitive, or items that are more sensitive than the rest?
Well,
in your way of doing business.
Well, one thing is that we stay away from kind of the financial engineering trickery. Okay, so overpaying for businesses and using high levels of leverage and kind of thinking, we can wing it. We stay away from that type of stuff. And that's kind of a trader's mentality to doing private equity. It's like buying an asset just for the sake of buying it and assuming that you're on kind of the growth curve and thinking that you can flip it in 2 years. A lot of transactions were done that way. Okay, so you buy a business for 10 times and you'd use a 7 and 8 times leverage multiple in the transaction, and you think, in 2 years we can sell it again because we're in a high growth market and a exuberant M&A market, and as long as we stay on that growth curve, we can make money that way. We've stayed away from those types. Fortunately, stayed away from those types of transactions. What we do is we really focus on the operating side of these businesses. We have about 60 to 70 ex-CEOs of major Fortune 500 companies, ex-CEO of Coca-Cola, ex-CEO of IPSCO, ex-CEO of Campbell Soup, ex-CEO of one of the largest aerospace and defense spare parts type of business. We bring these people in an advisory capacity to transactions that we do in particular sectors. So we're very, very kind of strategic, focused, operating focused, and we want to buy businesses to create bigger, better, more profitable businesses. So we're not in the financial engineering game. We're about supporting, actually, and you're talking about management, supporting management teams to take a $500 million business to $1 billion in sales, and how do we get there? And then support that growth plan with an equity infusion. Now, as far as management is concerned, you have to do your due diligence in management, because particularly in the middle market sector, if you get it wrong with respect to management, it is a huge headache to change management in the process. And I've actually just gone through one in one of our portfolio companies, and thank God it worked out fine. But we made a mistake. We did not do thorough due diligence. We actually did not hire the people that we should have hired to do an evaluation of the entire management team. And we thought, you know what, I think these guys can do it. And turns out they couldn't. And we had to change management. We had to change the CEO. And it was a huge problem. And you know, it's incredibly destabilizing to a business. If you do that to a $5 billion business or $10 billion business, it's different, because there's a huge organizational structure typically in that business that is very, very difficult to destabilize. So the CEO, you know, maybe it's, you know, people talk about it, but it's not going to be incredibly destabilizing to the business. If you're dealing with a $500 million business, it can be. And you know, there's some magic between the whole management team and the whole operations of the business. If you change the CEO, then somebody else leaves. The CFO leaves because they were friends, and you know, before you know it, you have a big headache on your hands. Go ahead.
So I'm just curious as to your views and your experiences and how you evaluate management. It seems to me to be one of the most toughest spots to really get your head around. So I'm just curious as to what guidelines you follow or what you suggest in order to make sure you don't make a bad mistake.
Well, I mean, the easiest thing is just to look at their track record, right? So what type of businesses have they managed in the past? And what happens is, what you typically find is that the management team of a $500 million business, that you look in their past and they've been there for 15 years and they've grown the business from $100 million to $500 million. But can they manage a $2 billion business? And the answer is probably no, unless you give them a lot of guidance. And sometimes we do that. So sometimes we make the bet on the CEO or the CFO for that matter. But when we give them a lot of, after having run the reports and after having these due diligence people come in, interview them, and making an assessment of their core abilities, sometimes we need to complement their skill set with adding on other people, or in some cases even giving them training as we go through the process. So the firms that do these types of reports, and these are the typical headhunting firms that have also a whole private equity business to their services, to their consultancy services. They do these types of evaluations and they come up with a whole report and they say, well, we think that this CFO has these types of skill sets, but if you want to take this business, if you're asking us if he can manage a $2 billion business, the answer is no, but there are some solutions that we can provide, rather than actually changing out the CFO. Okay? Any other questions? All right, so that's a quick overview of kind of the due diligence work that we're constantly faced with on a day-to-day basis and how incredibly important it is. We started doing some research and we said, wow, this optical retailing business in the United States is huge. It's like a $20 billion market. It's a very cyclical business. The incredibly competitive business, but dominated by LensCrafters and Pearl, and then also later on by Walmart that have, you know, if you walk into a Walmart, you have these, you can buy a pair of glasses. You can actually have your eyes checked and walk out of there, you know, spending $60 or so, and you have a pair of glasses. Eye Care Centers of America is another huge consolidator of kind of mid-market optical retailing stores in the United States. These stores are typically very large with an eye doctor on the premises, and fairly low average ticket price. And actually this has gone substantially lower also with the advent of Walmart, and sales per square foot of about $400 per square foot. And these businesses were typically kind of high volume type of businesses with low margins, low store EBITDA margins, okay? So not really an attractive business, you know, it's very competitive. Why the hell would we want to get into this? So, but then we did some more research, and when we looked at the luxury optical retailing sector, there was a sub-segment of the optical retailing business here in the United States, also in Europe for that matter, where it was a very small subsector. It was about $400 million in sales, only 3% of the total market, very fragmented ownership. There were these mom and pop type of stores, very small type of boutiques, very high sales per square foot, and a very high average ticket price, and incredibly high gross margins, okay? So these were mom and pop operations that were selling Cartier and kind of proprietary, these very small proprietary brands, and people were walking in there and spending $1,200 for a pair of sunglasses, okay? So, or spending $2,000 for, you know, gold-rimmed, diamond-encrusted, special Zeiss lenses type of glasses. And very high store EBITDA margins. And also what you notice is that these businesses were non-cyclical. That the people that frequented these stores were true luxury buyers that would buy, were willing to spend high dollars on these fashion accessories, what it really become, and regardless of the macroeconomic conditions, these stores typically did well. So I said, okay, kind of interesting opportunity. So we started getting intrigued about this opportunity by looking at the industry and the competitive set, and we said, well, you know what, this could, given the fact that there's such a fragmented ownership, this kind of reeks of, you know, potentially an interesting consolidation play opportunity, okay? So what are the, who asked a question about consolidation play earlier? Okay, Carlos. So what are the characteristics of a good consolidation play opportunity? What does it mean, a consolidation play? Why the hell would you go through a consolidation play?
Generally, you have to believe that, well, first that putting together these individual assets, that you'll have more advantages bringing them together, either from the cost side or revenue side.
Okay.
So there is value to add to consolidate the industry.
But just be specific. So what kind of, so you're consolidating these businesses, regardless of the industry, what kind of benefits do you have by consolidating them?
So you can have, in terms of suppliers, so you can have just one centralized negotiation with an important supplier.
Okay. So what does that do?
Reduces your cost of goods sold.
Right.
You can have lower marketing costs because then you can have a unified brand, and you can get the same number of customers with only one brand.
What else? So you said marketing, you said gross margins, marketing, what else?
Maybe benchmarking within the store, just like knowing what works and what doesn't work.
Okay. You mentioned something.
Also revenue, so you can transfer best practices.
Yeah.
And hence increase the overall revenue growth.
Right. So best practices, gross margin, marketing, what else?
And you reduce competition, right? You can get your back office in terms of G&A costs, you can really reduce that. There's a huge amount of leverage. And just, I mean, there's an intangible aspect of it, which is just by having more of these stores located everywhere, you create a brand awareness that potentially leads you to be able to charge higher prices.
Okay. All right. The thing that you have to realize with consolidation plays, that bigger is not necessarily better with consolidation plays. It makes businesses more complex. You really need to know what you're doing. The opportunities that we were just talking about are not necessarily always there. And in fact, in many cases, they're not. But in this particular case, and particularly in the retailing business and the luxury retailing business and luxury optical retailing business, we kind of discovered by doing the due diligence that we were doing that, you know what, this actually meets all of the aspects of what good consolidation plays are really about. It's a large fragmented market. There are no dominant players. It's very important. There are so many consolidation plays that have been done here in the United States and in Europe during the last 20 years where they do consolidation plays while there are a couple of dominant players in the market. Why the hell would you do that? Say, oh no, just because we can we have a bigger share of the pie. Well, but if you're doing that with a dominant player in the market, you're dead in the water. So consolidation plays are actually, in the truest sense of the word, they should be done when there's no dominant player in the market, when you have a fragmented market, and by consolidating, that you become the dominant player and the biggest player in the market. In this business, it turns out, if you really looked at the luxury optical retailing business as a subsector from optical retailing business, because these two businesses, the mid-market type of business, had actually nothing to do with each other. It sold different products. It was a whole complete different game. So you could look at the luxury optical retailing business as actually a business that was a business as its own. And by doing the consolidation of a bunch of these operators, you could actually become the dominant player in the market. Okay? So very important not to do consolidation plays when there are dominant players, because there's no point. So consolidation will create an immediate market leader, a large. The other thing is to find acquisition platforms that are relatively large, meaning doing consolidation plays with hundreds of little players can be an absolute nightmare, because the process of actually consolidating companies is very complex, very, very difficult, and the sum of the parts, you end up with a bad business that is virtually like creating a new business. Inefficient market, very, very important, very, very hard to find. Typically, these businesses that operate in these businesses know everything about each other. Okay, so it's very hard then to do a consolidation play, because they all start talking. And when they start talking, what happens? What's the problem of having a very efficient market and trying to do a consolidation play in an efficient market? What, Tom?
They start negotiating with each other.
Exactly. They start talking to each other. They literally pick up the phone and say, hey, were you approached by these guys? Yeah, so was I. So start colluding. And it happens, trust me. It happened to us. It happened to us in this situation. So now it didn't happen in such a bad way that we couldn't do the deal. But okay, gross margin opportunities. There have to be clear cost of goods sold opportunities. There are many consolidation plays that are done, and people talk about consolidation, about cost of goods sold opportunities because we're a bigger player and we can go to the suppliers and we get bigger discounts. Well, if there's a dominant player in the business, you go to your suppliers and say, well, so what? I don't care if you've got, I don't care if you're double the size or triple the size. You're still not my most important customer, and the discounts that you're asking for, you're not going to get them. And end of story, okay? Because it's actually one of the most important aspects of the consolidation play, that you have immediate gross margin improvement, okay? Economies of scale and operating expense opportunities. Clearly, by consolidating businesses, you need to have a clear and well thought out plan, and you need to have done your due diligence and get people involved that really know what they're talking about when you're discussing operating expense improvements and benefiting from the economies of scale, such as SG&A opportunities when consolidating all these businesses under one roof. Because if you do it badly, it actually ends up costing more rather than less. Okay.
Just kind of curiosity in the luxury market, how do you kind of press the supplier that where their brand is also extremely important and where you already have kind of a 65% gross margin?
Because in this case, we were betting on the fact that we would become the most dominant player. And I'll get into some of the aspects as to why we were the most dominant player after the consolidation. But take Cartier, for example, right? They want to be in the highest end stores in the United States. Well, there are only a handful of them. You know, there are 10 kind of major cities here in the United States. They may have, you know, 1 or 2 kind of really high-end stores, and Cartier wants to be in those stores. If you own all of those stores, trust me, they'll talk to you. Okay, go ahead.
No, yeah, one question. One of the most important issues in the luxury business is inventory management, and when you have much bigger scale, it's much easier. So how do you factor this in your analysis? If gross margin is not possible to improve through this scale?
Well, gross margin is possible.
Yeah, assuming you'll get just a little bit. I'm not sure to what extent the fact that you have a big scale kind of helps your investment thesis, and I'm asking to what extent is
Okay,
this?
I'm going to get back to your question because it's actually one of the most important aspects of this deal that we discovered while we were doing due diligence, while we were doing the financial due diligence.
20 minutes.
Huh?
20 minutes.
That's it? Okay. All right, I'm talking too long and too much. All right, so I'm going to skip this. You already understood that this was a consolidation opportunity. You guys have done this 100 times. Porter's 5 forces analysis. Don't forget, it's really important. It really is. It may seem mundane, but we do this stuff every single day. Barriers to entry, supplier power, buyer power, relationships with suppliers, and you'll see down the line that it's a very important aspect. In any case, when we financial due diligence, so we look at the balance sheet, income statement, and the cash flow statement of the business, obviously. And one thing not to forget is who is doing really the financial statements. There are thousands of privately held companies in the United States, large companies that are unaudited, okay? So who's really doing the financial reporting? If major red flag, if they don't have audited numbers, beware and get some really good accountants to do the financial due diligence for the firm, because you'll find a lot of mess and a lot of problems in those books. And you'd be surprised how many companies are out there that don't have, large companies that don't have audited financials, okay? In any case, when we're doing the financial due diligence of this business, and when we were looking at the balance sheet, we discovered some interesting things. You were talking a little bit about the inventory. The biggest asset in this business, this is obviously the inventory, right? We're not talking about a steel manufacturing plant that has huge amounts of assets and needs a large amount of assets to generate its cash flows and its profits. In this business, the only asset and the only real asset that the business has is really, apart from some intangible assets, is really the inventory. Now, it turns out, unlike the middle market sector or the mid-tier kind of optical retailing business, is the way that these guys were financing their inventory was incredible. I couldn't believe it. When we were doing the financial due diligence, we discovered that these guys had 250 to 300 days payable outstanding on their balance sheet. What does that mean? What?
They virtually get it for free until they sell it, so you have negative working capital.
Exactly. So they're basically getting their inventory for free until they sell it. It turns out that the luxury optical retailing business has this kind of age-old business practice that you buy the inventory, but you don't pay. And you don't pay unless you've sold it. So these guys all had, we started looking at one for the next acquisition target, and it turns out that all of these guys are in the same situation. We couldn't believe it. They all had like 200, 250, and we would ask them, say, well, why haven't you paid your bills? I said, no, they never bother us. Okay, great. So so what essentially was happening is that they were buying the inventory and they weren't paying for it. Not only that, if they didn't sell the inventory within 250 days, they would literally get a box, they would wrap up the Cartier frames, put a big sticker, Cartier, SRL, wherever it was, and send it back. And they'd get a credit. Go ahead.
So that's obviously an attractive thing, but I would be worried about that as a buyer because, if they figure out that they own the inventory and it's just a matter of finding a customer, then I would think that there would be a lot of potential for competition from web-based e-commerce sites that could sell that inventory for them. In other words, it would sort of disintermediate the retail channel.
No, because this is such a high-end type of business that the inventory that was taken back by the suppliers was actually destroyed. Go ahead.
To Aaron's point, actually there is another risk factor, which is if the industry practice starts to change, then your working capital, most like PE firms try to improve the working capital margin over time. But if the suppliers start pushing down the AP days from 260 to 250 to 200, that can have an immense impact on the cash flow of the business.
Yes.
So that would be a risk factor.
And you know what? You hit the nail on the head, because this is what happened. So we went through all of this financial due diligence, and it's in the interest of time, I can't go through all of it, but you kind of identified the key aspects of this. We were going to do this consolidation play where we're going to have substantial benefits from a gross margin perspective. Now, just one little side note here. It's very, very difficult to predict what those gross margins are going to be because you just don't know, right? So in your financial models and your kind of predictions of where the business is going to go, you don't really know. So here again, the due diligence and getting expert opinions and getting outside information and outside opinions in this whole process is very, very important to narrow it down and that you really mitigate as much as possible some of the errors that you're bound to make in making these predictions, in consolidating 10 or 20 of these businesses. So, but we were pretty comfortable that we were going to get these gross margins improvements, and in fact we did. We got our predictions pretty right from a financial perspective. We had KPMG in there, we didn't find any red flags, and if we did find them, we kind of dealt with them. We did a very, very good transaction. We negotiated very, very cleverly. It was a beautiful transaction. So in any case, I've kind of jumped through this whole due diligence process, but the point I'm trying to get across is that when you do your due diligence work, and people have the tendency to think, oh, it's all about financial due diligence. It's not. Due diligence really is a much broader concept. It's understanding the business, understanding the environment in which it operates, and truly understanding the business's operating model and the people that are managing your business. And if you think of due diligence in that concept, and you get the right people involved, because you can't do it all by yourself. There's no way that you can do it by yourself. Because ultimately what we do is we are the managers of this process. We lead the process. We are the leaders of this team of 40, 50 people that are working on a particular transaction that all know really well what they're talking about. And putting all of those pieces together. And if you look at due diligence from that perspective and not think about only the financial due diligence, then you're on the right track. And it will mitigate some of the risks, and it will ensure that you don't make big mistakes that you're inevitably going to make in this business. And you learn from your mistakes. So we talked about the management. And by the way, we had brought into this transaction an incredibly smart guy. Bernard Andrews is the former CEO of ICA Centers America, which was one of the largest players in the mid-market type of sector. And he was incredibly valuable to us in how we structured this transaction. I was just talking a little bit about how we projected the business going forward, how we were going to grow the business. It was a combination of organic growth and new store openings, and also acquisitions. We did a very thorough analysis of the exit considerations for this business. There were a lot of strategic buyers in the sector that were very interested in buying a consolidated platform, and that remains true to this day. We still haven't exited this opportunity, but we will someday soon. Here are some of the comps that we ran at the time. Okay, in the interest of time, I'm going to skip forward and just talk about two last things. When you do a leverage buyout transaction, what are kind of the key, and I really want to leave this with you because this is really so important. The whole structuring a leverage buyout transaction is not that or let's say the concept of the leveraged buyout transaction is not that complicated. You're leveraging cash flows. You're buying a business, leveraging the cash flows. But what are the 4 key drivers of any leveraged buyout model? What are the 4 key drivers of your IRRs? Tell me.
I tend to think of 5, but I'll try to look
Okay.
at 4. One is sales growth.
Okay.
Second is profitability.
Yeah.
Third is free cash flow conversion.
Yeah.
Fourth is leverage. And then 5, I think, is multiple arbitrage.
Okay. Right. Now, what is the single most important one of those 5?
Growth. I'd say
What?
Generally, operational growth, because that gets multiplied.
Okay, but what does that lead into?
Stable, predictable cash flow.
Yeah. Okay. You just mentioned. I'll have to go back. Sorry. Of these 4, you mentioned 5. What is the? Well, they're correlated. What is the single? What's the single biggest driver of your return, of your IRRs? I mean, if you're doing a leveraged buyout model, and you're playing around with the numbers.
When you look at leverage, that's generally a 1-to-1 gain. When you look at the growth in your free cash flow, right, there's a multiplier effect to it.
Yeah.
And so that's really where the growth comes from, your operational growth.
I would say it's multiple arbitrage. Okay. Where?
Start to get.
Listen, if you have the discipline of buying companies on the cheap and really being disciplined in that sense, it's your single biggest driver of your returns. And what I'm trying to leave with you guys is just do yourself a favor and don't overpay for businesses. Because if you overpay for a business, you're going to be stuck with it for years. And even if it's a good, sound, cash-flowing business, you try and sell it, and you're still going to be disappointed with the returns of the business because you overpaid for it. And multiple expansion and multiple arbitrage by creating bigger, better, more profitable businesses, and by really doing some hard work and spending the money on improving the business and really making a great company out of it, that's where you really get your multiple expansion. Because people want to buy great businesses. People will buy great companies. People will buy companies that are well run. And if you find companies that are run so-so, and you can really fix them and improve them and make them bigger and better, you're going to make a lot of money in the whole process. And